Welcome to another lecture series on LAUTECH Open and Distance Learning Center. This is ACT 202 Financial Accounting 2, and I'll be taking you through study session 3, that is Final Accounts of Non-Profit Making Organization. As you have already learned from study session 2 of this course, that the major objective of non-trading company is to carry out purely civil transactions. Non-profit organizations do not have commercial owners and must rely on funds from contributions, membership dues, program revenues, fundraising events, public and private grants, and investment income. Hence, there is need to study about the kinds of books and accounts kept by such organization. At the end of this study session, you should be able to explain the final accounts of a non-trading organization, discuss the preparation of receipts and payments accounts, explain the preparation of income and expenditure accounts, discuss the preparation of balance sheets, as well as explain the differences between trading and non-trading accounts. Items of the final account of non-trading organization. The final accounts of a trading organization include a profit and loss account as well as a balance sheet. But in the case of a non-trading organization, the following accounts are involved. 1. We have the receipts and payments accounts. 2. Income and expenditure accounts. And lastly, we have the balance sheet. Now, subsequently, we'll be considering each of these accounts one after the other. The receipts and payments accounts. You will notice that a non-trading organization has to prepare receipts and payments accounts and the income and expenditure account. You have also learned that the profit and loss account and the balance sheet are usually prepared for profit-making organizations with the aid of a trial balance. However, in the case of a non-trading organization, the practice is to prepare the income and expenditure accounts and the balance sheet straight from the receipts and payments account and the additional information. The main features of receipts and payments accounts can be summarized as follows. 1. It is a real account. 2. It is a summary of cash book. 3. All receipts are shown on the debit side. 4. All payments are shown on the credit side. And lastly, the cash and bank items are merged except in the case of opening and closing balances. Income and expenditure accounts. As stated earlier, the income and expenditure account is prepared with the help of receipts and payments accounts, as well as the additional information that is available. However, you are also aware that the income and expenditure accounts will show incomes and expenses only for the period to which it relates, and that too on accrual basis. Hence, while taking figures from receipts and payment accounts, you will have to make the necessary adjustments. For instance, if the amount of subscriptions received during 2008 includes 200 naira relating to 2009, it should be deducted for purposes of computing the income from subscriptions. And similarly, if certain amounts of subscriptions relating to 2008 are still to be received, that is outstanding, it will not appear in the receipts and payments account, and this is because it has been included in the income from subscriptions for 2008, and so it's added there too. Relationship between income and expenditure accounts and the profit and loss account. The income and expenditure account serves the same purpose for a non-trading organization as the profit and loss account for a trading organization, and it's also prepared exactly in the same manner as the profit and loss account. That is, all incomes are shown on the credit side and all expenses and losses on the debit side. However, in the case of non-trading organizations, the excess of income over expenses and losses is not termed profit. It's called excess of income over expenditure or surplus. Similarly, the excess of expenses and losses over income is termed excess of expenditure over income or deficiency. Preparation of balance sheet for non-profit organization. The balance sheet of a non-trading organization is prepared in the same manner as that of other organizations. It shows all assets and liabilities as at the end of the year in the usual way. However, the excess of assets over liabilities in their case is termed capital fund or general fund, and not capital as in the case of a trading organization. And the capital fund actually comprises the excess of income over expenditure and other incomes like life membership fees and entrance fees, which have been capitalized from time to time. Effectively, it constitutes the capital of the institution. Sometimes you may also have to prepare the balance sheet at the beginning, and this requires merely ascertaining the opening balance of the capital fund. Differences between trading accounts and non-trading accounts. The differences between trading accounts and non-trading accounts can be summarized using the table as shown above. For the trading accounts, the final accounts of a trading organization include trial balance and the profits and loss account as well as the balance sheet, while for a non-trading account, the final accounts include the receipts and payments accounts, income and expenditure accounts as well as the balance sheet. For the trading account, the excess of income over expenses and losses is termed profit, while in the case of a non-trading account, the excess of income over expenses and losses is termed surplus. In the case of a trading account, the excess of expenses and losses over income is termed losses, while in the case of a non-trading account, the excess of expenses and losses over income is termed deficiency. And lastly, for the case of a trading account, the excess of assets over liability is termed capital, while in the case of non-trading accounts, the excess of assets over liability is termed capital or general fund. I hope you had a wonderful time listening. Thank you.